And when I think about capitalizing the business, the first place I always start in the same way I started with my first company is how do you raise money from customers or through revenue? So I call it customer financing or revenue financing. That's a fancy term for like, can you just make money without asking anyone else for money? And there's some different ways you can do it. So if you are a enterprise SaaS company or some software company, especially in the early days, there's lots of ways you can pre-sell contracts and pre-sell your software just to de-risk it for yourself as the founder of like, is this actually really a thing? Because I think the worst thing you could do is invest 6 months a year building something that nobody wants. And the only way you know if someone wants it is they actually sign a contract and agree to pay you for it, and ideally pay you upfront for it. If you're an e-commerce company, there's a few other ways you can do it. For example, we have a partnership with Indiegogo. Kickstarter is another option. You can do it on your own. Can you actually just generate pre-sales before you have to commit to inventory? Again, as a way to de-risk it and also generate cash flow for you. Or once you're in flight, can you do things like, for example, my first company was a subscription beauty box company. And we built the business or financed it by selling annual subscriptions. We got it up to about 52% of our subscriptions were annual subscriptions, which meant I got 12 months of cash upfront to finance all of our operations. And that's how we bootstrapped the business. That's the only way it really worked. And so I'd encourage you to explore that. Or if you're not a subscription-based business, I think you can look at things like doing deposits for drops. Like a Tesla is a very famous example. Even a company as well capitalized as them, you had to pay $1,000 or $5,000 to reserve a car, and they made a few $1 million on reservations before ever selling you a car. And lots of our portfolio companies do that as well. And so that's the customer financing side. And I'll say start there, because if you're making money, if you're profitable, raising money becomes infinitely easier because you have leverage. And so I think the way you can look at your different financing options is, I would think about equity capital as things that will help you take you from 0 to 1. So meaning you have an idea, you have some demand, and you need to start it. That's where angels, friends and family, or ventures are a very good fit. When you're kind of at scale and growing and have some traction, that's where a solution like Clearco can help on some parts, where if it's a repeatable expense, like a marketing investment or inventory, the return on that investment. Don't spend expensive equity on that. Use our form of capital or comparable revenue-based financing option to do that, and save equity for new products, team expansion, things like that. And Jim, I'd love your thoughts on the exit part, but in my perspective of how we approached it, really anytime you're thinking about raising a institutional round of capital, so you call it your seed, your Series A, your Series B, I would always recommend looking at it as a parallel path. And you'll find different buyers at different stages, but there are lots of buyers, especially today, that are able to buy businesses in the few $1 million revenue range. So you're never really too small to sell, even at this stage, especially now. And that just gives you optionality. So if you have one term sheet that says, here's what an equity investor will put into me, and you have another term sheet to say, here's what I will sell at, one, that gives you negotiating leverage, and two, that gives you personally options to decide what you want to do. So hopefully that's a concise picture of all of it, but there's a lot to talk about at each of those ideas.
Yeah, brilliant. I think there's naturally various ways, and very interesting as to how you were able to fund your own business previous to Clearco by charging annual subscription. So there's various ways. It's just about having a great product / service, making customers happy. Then alongside that, the sky's the limit, and one can be quite tactful as how they can raise funds. Jim, if you can share your perspective next, please.
Yeah, I mean, cash flow is the sort of make or the break of most businesses. I mean, especially in a high growth environment. So, I used to explain to my friends, if you have a business that's growing 30% a year and you make 30% margin, if you have one product doing 30% growth, you don't have any money to launch a new product, let alone pay yourself or build your team. So the only way to grow is to raise money or push the cash flow pressure onto your supply chain. And if you have relationships and volume building over time with your supply chain, you can push some of that onto your headache onto your suppliers. But at some point, if you're ambitious, you've built the foundations of a successful brand, you're probably going to end up raising money one way or another. Some businesses manage to just push it all on supply chain, but I think it'd be naive and unfair to say that's what everyone should do, because it's not a reality for most people.
Yeah, fair enough. And then in context to some of the things that you mentioned, what are the key kind of indicators, when might be specifically a good time to raise money, or is there such a thing as the right or wrong time to raise money or exit? As a follow-up question to you, Jim.
For me, look, when to raise money. I mean, fundamentally, if you've got a business on a great growth trajectory, the biggest handbrake on that growth is going to be cash flow. So the question around when is, as soon as you see that growth, that growth potential, the one thing that's going to frustrate you as an entrepreneur and business owner is that you can't deliver the potential of the business because you haven't got the cash to feed it. And you'll know when that moment comes. And it can happen in the first 6 months of starting a brand through, years into the business. But fundamentally, even the most successful growth businesses sometimes end out of business because they don't have the cash flow. They're not planning their cash flow effectively. It's not easy. So I don't think there's an easy way to say when, but most owners will know when the right time is for them. And then it's about what are the options available to them. And the market's matured a lot. I mean, I tried to raise money for an Amazon business in 2014, 15, and all that was available then was Amazon lending. Because you go and talk to a bank about an Amazon FBA business, they thought you were crazy. They just didn't get it. And then, some fintech entrepreneurs came along and went, hang on, this is an amazing category. And, funding started to come. But for the first few years, the only option was family, friends, or Amazon lending, which, they owned that space. So, we're lucky now. I think e-commerce has really developed in the last 3 years, and all of the service provision around that has grown with it, which gives sellers more options than they've ever had.
Yeah.
When you're talking about the options, I think it's like the interesting subject would be, do you see like what are the options that are available at the moment and that they were available by the time that you've been growing your own businesses, both like Daniel and Jim? So I guess one thing that we see in the UK is that like if you are a business that started like a few months ago, and even though you see the good growth rates on your like Amazon store, you still will have a hard time finding the loan provider that will basically give you the loan. So it's probably like, as far as we understand, it's very hard to get the loan from the high street banks. There are now like more and more solutions from new like fintech companies. But what's your experience? Like, are there a lot of options available like early in the career of the entrepreneur? I'm also looking at the poll we've done, and we see that a few of our listeners are in their like between year 1 and year 3. So like, what do you think? What would be available for them?
I think Daniel's probably better placed to answer this than I am.
Yeah, I mean, I think you already touched on it, Jim, in that the earlier you go, the harder and harder it is to raise capital from traditional investors, especially for something like an Amazon FBA business, because an investor who's not familiar with the space won't understand the business, because it's like, oh, so you just sell this like one SKU on Amazon, like that seems like a casual part-time thing. It's not a serious business. I don't get it, because they're looking at it all qualitatively, and you can show them all your numbers and all your metrics. It won't matter like, oh, but that doesn't feel like if you're equity investor, like I don't understand what like I'm backing with my equity dollars. And I think there's, the certain part of that I would say is correct in that when you think about very, very traditional venture, we can take it a step aside for that world. The way a VC fund works is that ultimately they need each of their companies to have a chance at being able to return the fund. So what I mean by that is if you are raising venture capital from a $100 million fund, they have to have the belief that by putting a check into you alone for the $5 million, $10 million they give you could return $100 million for them. Because what happens in real life is that $100 million, let's say they put 10 investments at $10 million, $30 million is already written off because 3 companies will fail. So they're already down 70 million. The other 6 of the 7 maybe will return the capital back to the fund. And so, they've given you out 100, they're made back 60. So they need to make up another 40. So for them to break even, they need you to at least 4x your value, if not 10x your value, to actually make their investors happy. And so a lot of these great e-commerce companies are amazing businesses, but are not amazing for venture capital. The return profile just doesn't make any sense. So it's not a product market fit for a lot of these investors. When you think about banks, it's kind of the same situation. A lot of them will have very, very traditional looking at assets, looking at taking lien on assets. And if you just, if you're trying to run a lean operation where it's all just in time, all of that, you have no collateral to put up. And so ultimately, the only choice you'll have is to give up a personal guarantee or personal security. And so, again, it's all choices. There's nothing good or bad about any choice. But that's something for you to think about. Of the true downside scenario is, what is the expected chance that you think the business will fail? Multiply that by like, what is it you're putting up personally in security? Is that cost worth it to you? If so, then like, fine, I'd pursue that option. If not, fortunately, there's a lot of different options. Us being one example of it, where we simply evaluate you based on your revenue. You plug in your Amazon account, your Shopify account. We ingest the data. We look at it. We come back to an offer within 20 minutes to 24 hours, and we don't take any security. And so it's just meant to be. It's a product built to finance and capitalize these types of businesses. And then our hope is, with folks like Jim's group at Thrasio, or wherever else you choose to sell. I see about 50% or 60% of people are looking to sell. At that point, all you have to think about a founder is, how do I start hitting milestones to grow my business? And you'll understand, talking to anyone in the space, you'll know the multiples, you'll know roughly what you can sell for, and then you can kind of choose to pull that trigger when you want, assuming you're continuing to show growth and showing consistent unit economics and all of that. So it's kind of a long answer, but that's kind of my personal view on how to navigate fundraising.